Hey guys, welcome back to another video by Fully Informed Trade, or FiTrade for short, knowledge for everyone. My name is Alex Cho, and right now I am going to be talking about the GLD market. This is a really interesting market. At first it kind of seemed like the gold market wanted to head higher, even as the Euro-US dollar was falling. But it turns out that the gold market eventually falls back into that correlation pattern. It does fall all the way from that 50 and 20-day moving average back down to earth, and it goes all the way down to around $151.39. Now, 37 cents. Now, it is trading at the bottom end of the range, and I think that if it is able to break below this trend line, chances are it's going to head all the way down to 148.50, and then even further below that. I think that the dollar is still in a longer term uptrend. I think we're in a multi-month uptrend, and even into a multi-year uptrend, as I anticipate the European Central Bank to lower their prime interest rate. The main reason why I don't think gold will really benefit from the inflationary trade is basically because the demand for the precious commodity itself has also dropped, and the demand factors are really favoring the bond market rather than the gold market. I also want to mention the fact that even if gold were to go a little higher because of inflationary factors, it really wouldn't be by much, because right now we're talking deflationary and then inflationary. There are two different things. First of all, the current reality is deflation. The second reality is future inflation. Even if Europe were to come up with a $3 trillion bailout plan, it maybe even $5 trillion bailout plan for the whole European Union, okay, and they print out 5 trillion euros. Now you guys think, oh, well, that's 5 trillion euros. That's a lot. That's an amazing amount of inflation. In reality, it isn't, because 5 trillion euros is equivalent to less than 5% of perhaps all the outstanding assets in Europe. So the issue with currency is that there's not enough of it. And without enough currency units being transacted in volume, the liquidity does drop. And when liquidity drops, so does economic productivity. Even if you were to increase it by 3 trillion, 5 trillion, it really would just barely scratch the surface. But the markets would overreact. But then once the economic realities come out, once the GDP numbers come out, it won't really have as much of an impact as many economists will most likely predict. So overall, the way I see this market is that gold will continue to fall. I think that it won't really react to much of the ECB inflationary rate change, because the gold is primarily tied to the US dollar and not necessarily to the euro. But in response, because the gold is strengthening against the euro, it can be interpreted that the gold euro trade will continue to inflate itself based purely on the fact that the dollar is appreciating against the euro. Now that being said, I think that the euro US dollar will fall. I think gold will fall, mainly because it is tied to the dollar, and I think the dollar will continue to appreciate, and everybody is near 0% interest rate in the next coming year. I think that by 2013 everybody will have a near 0% interest rate, and I think that the Federal Reserve will most likely extend their interest rate policy for a couple more years as the European issues continue to unfold. So take care, folks. I hope you guys have a wonderful day. I hope you guys make money every single day of the year. So take care.